And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. ESG, I'm talking environmental, social, and governance. Well, it's been a hot issue for a long time. Despite the market downturn, there's still new ESG products being launched. Last week, industry leader Vanguard launched another ESG fund. That's the Bailey Gifford Global Positive Impact Stock Fund. That's an actively managed ESG fund. Let's talk with Matt Pirro. He's the global head of ESG product at Vanguard. Joining us from Vanguard headquarters in Malvern, PA. Also joining us, John Hale, global head of sustainability at Morningstar and our all-round ESG expert. Matt, Vanguard's already has several ESG funds, including funds that are indexed and run as exchange-traded funds. I'm interested in the fact that this is actively managed. Just tell us the rationale for launching another fund. How does it differ from some of the other Vanguard ETFs that are already out there, some of which are indexed?
Yeah, well, thanks for having me on the show to talk about this. The new fund, the Positive Impact Fund, as the name suggests, it's really a fund that's going to be investing in global equities, looking to deliver long-term outperformance by doing so in investing in companies that are contributing positively to really advancing and solving some of the world's most challenging problems, whether those be environmental or social or otherwise. Our other products that we offer, you've mentioned some of the ETFs that you offer today. Those are what are referred to as exclusionary ETFs, where those are types of products that effectively identify the types of business activities that clients may not want their money invested in, and we simply exclude those from the index itself. And the resulting portfolio, just pulls those stocks out and leaves an index-based product that remains. And then you mentioned the fact that it's actively managed. We absolutely think this Positive Impact Fund is well done from an active standpoint because we want to deliver on both an outperformance objective while investing in those companies that contributed positively. So we're just looking here to introduce more types of ESG products to cater to an increasing number of preferences that we're hearing from our investors.
Right. It's interesting about that distinction between inclusive and exclusive because you can, there's active and there's indexed, but there's also inclusive and exclusive in the ESG world. So you're looking to add companies that are trying to have a positive impact. So there's what I call an impact. It's interesting, top 5 holdings here, and I know you're not the fund manager, but I just want to point out ASML, Taiwan Semi, Moderna, Deere. These are big names, all known to all of us who cover the global markets. But I also want to point out that your other funds that are out there, the index funds that are out there, that are exclusive ones that exclude companies. So Vanguard's ESG U.S. stock ETF excludes adult entertainment, alcohol, tobacco, weapons, fossil fuels, gambling, nuclear power. And it also excludes companies that don't meet standards for labor rights, human rights. This is an ESG screen, but this is excludes. And what you're holding here is, in this particular ESGV is the symbol here. What you're holding here is Apple, Microsoft, Amazon, Alphabet. These show up in a lot of these exclusionary ETFs that are out there. I guess what I'm trying to point out here, Matt, is the distinction here between these two different kinds of funds, between exclusionary and inclusionary funds that are out there. And you seem to be trying to saddle both of these worlds, essentially.
Right. You are right. There are a couple different forms of ESG investing, and our newest launch there is what's referred to as an impact fund, so impact investing being one type of ESG investing. You have the exclusionary products, the one you're referencing there, where we're excluding companies based on their business involvement activities. But the third type, which you're referencing, is referred to as inclusionary. And inclusionary investing from an ESG standpoint, and we offer a fund, an actively managed fund that's done in this way. It's called the Global ESG Select Stock Fund. What they're doing is really looking to identify companies who are really leaders in the way in which they manage the risks posed to them by ESG factors. So they're including securities through stock selection based on that assessment of how those companies manage those ESG risks and opportunities as a way to help those companies really preserve the ability to deliver long-term shareholder value. So you're absolutely right to point out there's really 3 different forms as we're seeing it, with that impact, inclusionary, and then the exclusionary. And we now offer products in all 3 product categories to cater to an increasingly diverse set of preferences we hear from our investors in this space.
John, I wonder what your thoughts are on this. You're the all-round ESG expert for Morningstar. I've seen this with other funds, fund families that seek to have ESG funds that are inclusive or exclusive, and as Matt points out, even funds that are trying to have an impact and be actively managed. How does Morningstar view all of this efforts to slice and dice the ESG community?
Yeah, well, we define sustainable investing, the term we use kind of as an overarching umbrella term, as a range of investment approaches, a range that seek to deliver both competitive returns and better, positive environmental, social, and corporate governance outcomes. Some of them are more focused on the competitive returns part. Some of them, I think, are now starting to lean more towards this broader outcomes part, often called impact. I think what we're seeing is an evolution in the space towards including impact. We started off years ago, exclusions only. There really wasn't a lot of other information that you could bring to bear on these kinds of portfolios or using this kind of approach. Now we have, a lot of information out there about individual companies and how they're handling ESG risks and opportunities. But here's the thing, from the standpoint of investor demand, a lot of investors today, think individual investors, but this also applies to many institutional investors as well. A lot of investors today are sustainability minded, particularly younger investors, more so women typically than men, and women are investment decision makers in far greater numbers than they've ever been before. This means that they're comfortable with considering the broader impact of decisions, that they make in all facets of their lives as consumers, as citizens, as employers and employees. And sustainability, happens when we make decisions that both meet our own needs but don't compromise the ability of others and of future generations to meet their own needs. So it should come as no surprise that with more people being sustainability minded today, they would want an approach to investing that has sustainability in mind. But that's the demand side. It's a bit inchoate. It's not necessarily precisely defined, and it varies from investor to investor. And so This has made it very difficult for the asset management industry, the supply side, to understand that demand. And because of that, I think we're still seeing evolution in sustainable investment funds that asset managers are offering. They're clearly hearing more demand for this idea of impact and meshing that in to an overall strategy that also is seeking to deliver competitive returns.
Inchoate. It's been a long time since I've heard that word used in a sentence. I love it when you speak Latin to me, John. So you and I have been covering this for a while. ESG has evolved a lot in the last decade, but it's still facing a lot of criticism about the lack of standardization. I track what Gensler is saying. SEC Chair Gary Gensler says he wants more disclosure about what asset managers mean when they say a fund is ESG. In May, he proposed new rules. They're not out yet. They're not working yet. There was a proposal to establish disclosure requirements for funds and advisors that market themselves as having an ESG focus. He says there's a wide range of what asset managers meant and mean by when they claim they're ESG. He also says, and I'm quoting here, we've also asked staff to consider the ways that funds are marketing themselves to investors as sustainable, green, and ESG, and what factors undergird those claims. John, how does Morningstar view Gensler comments? Is the whole ESG space indeed a little too fuzzy and need to be more standardized in terms of the definitions? How do you interact with Gensler on this?
Yeah, well, we're preparing our comment letter now on those proposed rules. But I think in general, we agree that funds that are focused on some facet of sustainability, ESG, need to be more transparent. It's not that they're, I think, trying not to be. It's just that sustainable products anywhere in the economy need to be more transparent, I think, about what they mean when they say we're sustainable than do their competitors that are, kind of not saying that. And I think the same thing is the case in the fund industry. And you combine that with the kind of information that funds are typically kind of required to provide to investors, the fund fact sheet, the prospectus, the reports, the annual reports and semi-annual reports of traditional funds. Don't really get a lot of great detail in those funds. I mean, yes, you get the holdings, but the real in-depth detail about what's going on in this fund from an investment strategy standpoint, yeah, it's not. It's kind of hard to get. So I think using that model, a lot of ESG funds have not enough information to investors to demonstrate that yes, this is a sustainable product in this space, that as a investor interested in that's the kind of product I want. But I want to make sure it is. I don't want any greenwashed version of this. And so I think the SEC proposal is on the right track for sure in asking asset managers and telling asset managers they're going to need to provide more detail in what they mean by their particular approach.
Yes. So Matt, how does Vanguard view these efforts to, I guess the word standardize, for lack of a better word, to standardize what ESG is? Is it okay to have competing definitions of what ESG means? I mean, what's Vanguard's approach to this?
Yeah, I mean, ultimately, and this is something we've long believed in the 45-plus years we've been at this, it's really all about protecting investors and making sure investors can make the best decisions to meet their retirement outcomes or other investment outcomes in mind. And I think in the case of ESG, as is the case when any sort of market develops, it can develop very quickly. And it can lead to, and I think in this instance, perhaps some terminology that is a little bit less well understood, which can make it harder for the individual investors to really understand the products, how they're designed, how they're going to go about delivering on their objectives from a performance standpoint, or in the case of ESG, those ESG characteristics. So for us, our role as really somebody who advocates on behalf of investors is to make sure that, innovation, the right kind of innovation can happen, investors are protected, and disclosures are oftentimes a good way to do that. Obviously, the devil's in the detail in terms of the types of disclosures and the requirements and the like, and similar to what John mentioned with Morningstar, we're preparing our comment letter. But ultimately, we're going to be looking out for what we think is in the best interest of our investors, help them deliver on those investment outcomes in this space.
John, the market seems, correct me if I'm wrong, but it seems a bit saturated with ESG funds. And yet here's Vanguard, big player, launching a new fund. We have seen some outflows from ESG ETFs this year, but that's happened with parts of the broader market, too. But some ESG funds have also closed. I saw last week Kathy Wood's Transparency Fund, CTRU, which is, a quasi-ESG fund, closed. Is the market oversaturated, or is this fairly typical in a market turn down? Where are we in terms of the popularity of ESG funds in general?
Yeah, I mean, I think it's only going to grow further from here, Bob, because so many investors indicate an interest in investing this way. It takes a long time for that interest to actually manifest itself in investments. I think this is the case with any kind of new asset class, particularly as it hits the retail investing market. So, because individual investors revamping or adding to their investments, a lot of times, it takes some kind of event that happens in their life that causes them to make a change in their investments. So that only happens episodically with most folks. And so there could be someone out there, who's like a gung-ho for ESG kind of investor, but they may not have the opportunity to really do that for years down the line until they actually are able to make these kinds of investments. So I think the market is going to continue to grow. But as I said before, I think there's this concern out there, as is the case with any sustainability or any product out there across the economy that claims to have sustainability characteristics, that there's a proof point there that consumers want to see. And I think as funds get better at demonstrating that, then more investors will invest that way.
Yeah. Matt, John, it strikes me as right. I mean, investors want ESG product, and you're one of the biggest fund families in the world, so you provide product for them. Can you describe generally what Vanguard's approach to developing new investment products is? I mean, here, this makes sense to me. If you're trying to provide a product for investors who want something, you add an active management component. Vanguard's famous for passive low cost, but you have well-known active funds. Here you're adding another active component here. This is a little more narrow focus, but explain sort of what the philosophy is here.
Yeah, anytime we bring a new product to market, whether it's an ESG product or otherwise, we have a pretty stringent set of product design principles that we follow. We always start with the investment principle, so we want to be very clear on the investment outcomes we're seeking to deliver by bringing the product to market. But we also look very closely at what our clients' preferences are. And I think that's particularly important when it comes to ESG because the preferences can vary. What ESG means to one person means something different to another. So we very much think about that deeply as we roll out new products to the market. So we think about the investment side first, and then we look at the clients and their preferences and what that can ultimately mean for them. And then we obviously have to make sure that we can bring the product to market as really a world-class product. So we look at it from what we refer to as a feasibility standpoint. But it always comes back to the investment side. But I think in the case of ESG, there is a bit of an added element of the preferences that we're hearing about. And that's why if you look at this new product, one of the preferences we were hearing more and more about was, hey, Vanguard, we'd like for you to offer one of your low-cost, high-quality, long-term oriented products where we can see that direct connection to investing in companies that are seeking to have that positive impact in solving some of these world's challenges. So we thought that was a gap in our lineup. We looked at it, and we decided to close that gap. But in line with those product design principles we follow across our entire product development efforts.
And yet, and not to be picky at all, Matt, but the big thing here is Vanguard is a rather special company in a lot of people's minds. It is to me. I'm a Jack Bogle disciple. I've said that for 20 years. It changed my life meeting Jack Bogle in 1997. And I know the Vanguard of today is not exactly the Jack Bogle Vanguard of 25 years ago. And yet people will say, gee, Vanguard's acting a lot like a very typical large investment fund, now essentially investment family, putting out new products because there might be demand for it. Does this matter at all? I mean, is Vanguard essentially now becoming just a very, very big organization that has to supply product? And as John mentions, if demand is there, we should provide that product to them. And is that different than the old Vanguard of 25 years ago? I hear this from the old timers a lot. Vanguard is changing. It's not the same anymore. But what do you say to those old timers out there who think Vanguard was a very special organization itself?
Well, I think there's a lot of commonality in the way we've run our company for the entire time, and that's really always coming back to the end investors. That is not changed one bit. Right, the marketplace has evolved. The services and products we bring to our clients to help them meet their investment outcomes, that has evolved as well. And I think ultimately, if you look at somebody like Mr. Bogle, he was always, for him, it was more about, high cost versus low cost, not about active or passive, and really making sure that investors got a fair shake. And one of the things that we've observed over time, whether it's in the U.S. or other markets in which we operate, when we participate in a market, it tends to do good things for other investors, right? Because of our focus, our ethos around doing what's right for investors, lowering the cost of investing, simplifying it, quite frankly, to make it more approachable so that investors do invest, because we know that's so important. Investing early, investing often, actually taking that step is most critical to achieving investment outcomes over the long term. So, we absolutely have expanded our product lineup, but we're only doing it in places where we think there's an investment case and we can do it best in class. And there's absolutely a number of areas where Vanguard has not participated in the market over the past couple of decades, things that we did not think or do not think have investment merit for the long term. So we do pick our spots. We're very clear on when we come to a market, why we're doing it and who we're doing it for. And one of the great things about our ownership structure and that we're owned by our end investors of the funds is we only have one client to serve, and that's our end clients. And that's a really important North Star for us to have in everything that we do.
All right. John, you wrote a story a few weeks ago, I read your columns for Morningstar, saying it was time for, you called it Sustainable Investing 2.0. You said most people want corporations to treat their workers better. They want companies to take action to limit carbon emissions, et cetera, et cetera. But a lot of these sustainable funds missed the mark, you said. How so? How do we make these funds better at this point? Just give me a minute on what the point of that column was.
Yeah, sure. Well, I think it relates to what I was saying earlier in our conversation that we're seeing kind of an evolution of sustainable products right now because there's, I think, a realization that despite the continued high level of demand out there, investors aren't, when we talk about trying to figure out their preferences, yes, there's a range of preferences, but a lot of these preferences, if I could say the word again, are inchoate. They're not exactly incoherent, but they're just sort of like, I think putting the onus back on asset managers to say, here's generally what we want. You have to now figure out the specifics of it, because because it's an investment product, it also needs to have competitive returns. And so it's I think a greater challenge for asset managers than say, 20 some years ago when real estate became, a more retail focused asset allocation, area for investors. And it's more straightforward. Here, you've got to decide, how to do this. And I think being way more transparent with what you are doing, focusing on impact was one of the things that I mentioned, as well as on engagement with companies. And one thing I think that's somewhat lost in the current debate about ESG, however, is that a lot of the funds, as they have existed in just the past 5 or 6 years, and grown so much and have so much focus on them, is that it has sent a very important signal to public companies that ESG is important to investors, and this is happening at the same time that companies are realizing this is important also to our customers and our suppliers and the people that work for us. And so we're seeing a tremendous explosion of ESG focus in public companies that investors can now help along, help continue to progress.
Yeah, and yet
as
it's still there's stuff that makes people crazy, like this whole thing with Tesla being excluded from the S&P ESG fund. And a lot of people say, well, here's a problem. This is the problem. A lot of funds operating by wanting to include the best company in every sector. So they want to include the best oil company, the best tobacco company, and then they exclude Tesla because other automakers score, better on certain metrics like corporate governance. So most of these ESG funds, remarkably, include oil companies. So Occidental Petroleum shows up in a lot of ESG funds because it scores highest on certain metrics compared to other competitors in the energy space. I wonder if they score high enough to make a difference, or did S&P have a very valid point by excluding Tesla, for example? This kind of makes people a little crazy. There's a whole debate about this.
Here's the thing. Sustainability is complex, and there are two things that are kind of happening here. Does Tesla get a free pass for everything it does related to its environmental, social, and corporate governance performance because it's a leader in electric vehicle production, right? I mean, there's all kinds of other ESG issues now that come into play when you're evaluating a company and evaluating the potential ESG risks to that company and to its stock performance. So, there are these two elements. I argue that more ESG funds should combine those two things. A lot of them are kind of separating them, saying, well, on the one hand, let's just look at ESG risks that are faced by an individual company, faced by companies, and we'll consider that as part of our process and try to, mitigate against that. And in the case of this particular index in Tesla, they were like, well, there's more ESG risk there overall than other auto companies have right now. So, but that same index isn't really considering impact. I think we need to go to a point where we're combining both of those things, and there's a more overarching analysis of a Tesla. And so if Tesla is in the portfolio because of its impact, then you can engage with Tesla. Maybe it's a bit of a difficult engagement process, I think, currently with Elon Musk, but you can engage with Tesla about the ESG issues. And that's the same thing about oil companies. All ESG funds, they can make the choice, and investors can make the choice. They're not all fossil fuel free. They don't exclude all fossil fuel companies, all oil and gas companies. There's an argument to be made for engagement, for sitting down at the table and saying, we are large investors of yours. How are you going to get to net zero? How are you going to change your business?
Let me ask you, before I let you go, John, just to put on my strict investor hat, forget about what's good for the planet. John, is there any evidence that ESG strategies actually outperform non-ESG strategies? Forget about what's good for the planet.
Yeah, so the way I look at this, Bob, is that there's a lot of, I think more traditional investors and even academics out there that I don't think really get this so well. They like to take one element, which is, say, an ESG evaluation of a company, and try to assess whether that leads to outperformance. And I think what they get wrong about is that these the ESG investors or ESG investment products are seeking competitive returns. So ESG is not the only consideration being made in these funds. There's a broader investment process, and there's all kinds of reasons why a particular company might be in an ESG portfolio that might not be related to ESG. It might be related to, how well it's growing its earnings in the next 5 years. And so the way I like to look at it is, we have all these ESG funds out there. Let's watch and see how they perform. And the story with ESG funds on the whole is that they generally perform at least in line with their competitors. Over the last 5 years or so, during this tremendous boom in ESG, generally speaking, they've outperformed traditional investments. So I'm not saying they're going to always outperform, but if you have an idea with your investments that, we need competitive performance out of these investments, I think ESG funds have already demonstrated that they can provide that.
Yeah, it helps if you own Apple, Amazon, and Microsoft is a top 5 holding, as a lot of these funds actually do. But I think the jury's still out on it, but it's a fascinating subject. The viewers are endlessly interested in this topic, and I am too, and watching it evolve is a wonderful thing. That does it for this week's ETF Edge. I've gone a little long because it's a very interesting topic. I want to thank Matt very much for joining us, and John as well. We've asked John to stick around and talk a little bit more about the impact of this recent Supreme Court ruling on ESG funds. I want to ask John about that. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.